Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about 30 minutes here on Options Guy TV. All right, well, an interesting week, I guess, for lack of a better term. Choppy, nothing too exciting, except for that we did have NVIDIA earnings, and nothing happened with the stock. So that was interesting in itself. So I guess that's where we're going to start today's show. I don't really have a trade that I want to put on this week. We tried looking at a bearish put butterfly in the SPX last week, and that trade didn't pan out. So we're going to look at that. Well, if you wrote it all the way to the end, there was a chance to adjust. At one point in time, it was a little bit profitable, but I would not have gotten out at that point in time. So that trade is a bust at this point in time, because we did not make an adjustment on Wednesday when we had an opportunity to make that adjustment. And let's start by, we're going to go to the what if calculator today. So let's go over to the Tradier Pro. Let's go. Okay, so our trade worked out. Well, you know what? This is one of the weird times that I've done a trade as a protection trade in an underlying stock, in a fairly, like, extremely popular underlying stock like NVIDIA, and the stock actually just really went nowhere. As usual, I don't know about usual, but they blew the numbers out. They had extremely good numbers as far as their earnings were concerned. Their forecast and the comments in the conference call afterwards, everything was just bullish. All the pundits were excited about it, but the stock still is just doing nothing. So if you look at NVIDIA today, we see that, well, let's go back to the what if calculator. I'll pull this up here. We'll see that it's down $3.25. Now, they announced earnings. After the earnings announcement, the stock went down 6. Then it kind of played around and ended up being down 3-ish on the session. And then the very next day, it did much the same, just kind of hung around, battled to get back to even, and now it's down again. Bottom line is, this is the one area where our insurance didn't really help, where our protective strategy that we did, it was within that deductible. In other words, we just had somebody drive by and clip our mirror off of our car, if you will. And there's no sense calling the insurance company. It says you might as well just go fix it, because it's not covered by the deductible. And that's what happened today in NVIDIA. They announced on Wednesday, we've had 2 days for the underlying stock to try to drift lower, and it just hasn't done that. So the stock right now is at 143. I think when they announced, it was about 146 or so when they announced earnings, and now it's just hanging there. It's just not doing much. 138 is where our protection came in. We had a small deductible to get to that 138, and the expected move was around $12 or $13. I think 12.5 was the actual expected move, and that would have put you down right around 132, and that's where the center of our put butterfly was. And then from there on down, we actually would have been profitable on the way down if it would have went below our lowest strike, which was the 58.40. So we did extremely well if it made the expected move and it hung out in the wings of the butterfly. But if it really flew on down, we still could have gotten some benefit from doing the butterfly. That's why we we modified the butterfly in order to put this trade on. We paid $1.15 for it, and that was the good news, in that it was extremely cheap relative to the cost of just buying a put outright, and even the cost of buying a put spread. So very simple trade, very easy trade, cost us $1. If you've had NVIDIA, you've definitely made much. If you've had it for the last month, you've made way more than $1 on NVIDIA over that time period. So this was a bullish but nervous trade. Now, ideally, the stock would have went up at least $1 or more to the upside and help pay for the insurance. But instead, it decided that it's just going to hang right in this little area where we really don't get any benefit from where the stock was at to the beginning of our butterfly. So there is our modified butterfly. It didn't work out except for the fact if you were nervous about NVIDIA and you were thinking about selling it, this is a trade that you could have put on to try to protect yourself. All right. Next, we'll look at the SPX put butterfly. So we put the SPX put butterfly on. Market was hanging right around 58.80. This would have been on Friday. We had the market run up a little bit to about 5,900 and then come all the way back to around 58.90. Hang in this range on Wednesday. Had a small profit. We put this entire trade on for $2.70. And actually, I can write that down here. I don't think it's going to adjust my graph, though. Oh, that's in the trade thing. Yeah, I can't adjust it up here. But for $2.70, we put that trade on. And now the market has gone up. So obviously, we talk about adjustments usually on the show. It probably would have adjusted this on Thursday if there was an opportunity after the marketplace came back down to make that adjustment. But now it's Friday and the market is up a little bit more today, and that has made our position worthless. So 59.60, 58.75 is where it was at. It's trading for 30 cents on that option contract, 15 in the middle. Yeah, not much there to sell. You could maybe get a nickel if you wanted to do that. It's not 270 cents. There you go. So that trade is well, I guess I would say it was a bust, but there were opportunities to get out. And this is what I mean by the marketplace is just choppy. It's not that exciting. It's hard, having a tough time picking direction. We have the VIX run up to 18, 19, and now that's back down to 16, 16 and a half. So the euphoria of the election is kind of worn off, made a lot of things overbought, and things are just trying to settle in. All right. Lastly, the one stock that we wanted to go up was Amazon. So we did a short put spread in the middle of this Amazon trade. And let me grab this. And we're going to send this to the trade table. Okay, 1 second. And I see I have a question from Anthony. I'll look at that in just a second here. So let's send this to the trade ticket. At this point in time, it's trading at a midpoint of 127. If you looked at the chart in Amazon, right? This is what we were kind of targeting. Let me zoom in on this area. And it was right around, we had the 20-day moving average. The top of this little channel is right here, right at about 194. And we're now hanging out right around 198. And if we zoom back out, you can see that that was all the way back here too, where we're hanging out at right around 198. So we kind of breached that level a little bit, which makes you a little nervous on Amazon going into the weekend. We put this entire trade on for 85-cent net credit. So we are down 25. We're down about 40 cents on the trade. So it's very feasible to just close the trade and get out. I don't like that it breached this level right here. And going into the weekend, going over into Monday, if we don't get a little bit more of a bounce back up, this might just be a close on this scenario, but we have a 30-day option contract. We got some time for this to work out. As far as a hedge is concerned, I don't think I want to buy this and roll this down at this point. But I'm right there. This is a very, very precipice. I might do something before the close today. Markets are up a little bit. In general, the markets are doing okay, but Amazon is down about 13 cents. So it's just trading around flat. So that, I guess that would be my. I'm befuddled by what to do next on this trade. We're down 40 some cents. Max upside was 85 cents on the trade, so don't have any problems just closing this one out either. Okay, Anthony. Regarding NVIDIA butterfly trade, I bought it for 115 on Thursday, for 115, and on Thursday morning I was able to sell it for 50. So not a horrible loss. All right, well that's fair, and you were, that would have made sense that you could have got out for that, and it did. I mean, I don't know if you were playing it on just to be bearish, which I think going into NVIDIA's earnings, I feel like it's a little bit like Apple. When Apple announces earnings, time and time again, they have a tendency, the path of least resistance is to the downside. And I feel like that's what's happening with NVIDIA. It has such strong growth going into over the quarter, more often than not, that people will take that opportunity of the earnings report to sell it and actually just get out of the trade. So happy to hear, Anthony, that you were able to salvage some of the money on that and be able to get out for about half of what you paid for it. So 115, that's right where we were at. So when you put that together, we had that position on. Now, NVIDIA, gosh, everybody is bullish on NVIDIA. Like it is. Let's zoom out just a little bit, because there is nothing that I read or heard after the earnings report to indicate. If anything, the biggest concern was from almost everybody that was discussing the company was that they can't keep up with demand. They have well, they basically they can't make their chips fast enough. They're coming out with new chips. They're doing so many things that are good. If I were to think about NVIDIA right now, it's once again becoming an expensive stock. It's 142, 143 right now. I would think about, which we did on Options Guy TV over a year ago, and we actually did it inside the Tradier Pro software. We put together a portfolio of deep into money option contracts, NVIDIA. Actually, I walked through the whole scenario on the ride up from 500 up to 1,000, and managing the deep into money option contracts. And you can obviously have some to go down. NVIDIA, that was it wasn't really fair, I think, to talk about NVIDIA because it did so well over time. But if I were to look at a trade, I personally have a lot of stock in a retirement account in NVIDIA. Well, I don't want to say a lot, but I have. I'm long a lot of shares. I'm long more shares than options. But I would not mind, and I might actually do this now that the earnings report is out. Implied volatilities have came in. We're now trading at, it looks like about a 40% implied volatility. Historical vol is around 43. It's still not cheap, right? It's still not cheap implied volatility. But going out to the beginning of the year, let's go out in time a little bit further here. Let's go back. Thank you. And let's look at June would be 210 days out. I don't mind that. Vol is around 50% on that option. Ooh, I don't like that it's up that high going that far out. June, yeah. Okay, let's go back. There must be something that's going to happen in that month or something. That January. Let's do 91 days. I like that. IV's around 41. Okay, so you're getting back to normal historical volatility. You're trading right around 45% implied volatility. And in lieu of buying 100 shares of NVIDIA, which is $14,300 at this point in time to buy 100 shares, this will be, a suggested trade. It's not a normal trade that we do on Options Guy TV, but I do like buying deep into money options as a surrogate for owning the stock. Always pay attention to the intrinsic value. Looking at an 80 delta option contract. Let's look at buying this contract right here. 79.68. Bid ask is 26.95 by 26.80, which is not bad for deep in the money options. If the bid ask spreads were tight, on deep in the money options, as tight as the underlying stock, a penny wide, right? Or even a nickel wide. I don't know why, I personally would change my whole portfolio into deep in the money option contracts. The biggest issue is there are some stocks that you want to trade, and the bid-ask spread is just not tight enough when they get deep enough in the money, and you're giving up way too much to get in and to get out of the trade. This isn't bad. We're 20 cents, but it's still 20 cents. That's a lot on an option contract, right? On a percentage basis. So with that mentioned, this would be one that I would consider buying. If I were to add to my position, because I have stock, I have more stock than anything. I wouldn't buy more stock. This is the option I would buy. I would go out to February, 90 days. I would look for something that has an 80 delta, so you get fairly good stock representation. And that would cost me $2,688 to control, basically, and this is the way I think of it when I'm thinking about deep in the money options, 80 shares of NVIDIA, not 100 shares, 80 shares. The delta gives you a representation of how many shares this option contract would control. Now, as far as NVIDIA is concerned, every option contract represents 100 shares of stock, but this is going to act like 80 shares of stock, and you're only going to pay $2,688. So $2,688 divided by 14,282, you're putting up about 19% if we round up. So, and I'll find that to be the case. If you're looking at 80 deltas going out at different expirations, a lot of times it's going to be about 15 to 20% of the stock. That means that's your total risk. And you could easily lose more than that on NVIDIA with the valuation and where it's at. And you've even had that happen a few times after earnings. If you look back at a couple of quarters where it's gone down a significant amount. That is not the case this time around, but this would be an alternative to buying that 100 shares if you wanted to add to your position. It's still an option. You're still paying $6 in extrinsic value, and you got to make up for that. You can either sell some calls against it a little bit later on if you want, but keep in mind that you're initially buying $6 worth of time premium. You're still getting a lot of movement. I'm not going to probably stay in this for 90 days. 60-day would be my time frame. If you go a little more, that's fine. And if it ever did come down towards this strike, I guess if it got to about 130, I would then just get out of this trade. This is a hard stop on the downside. I've always said that if it hits your strike price, I definitely want to get out, because that becomes an at-the-money option contract. So if that happened tomorrow, right, your $16 option would be trading for what the at-the-money is at right now. It would be trading, and probably vol would pump up a bit, but you're looking at $13.70. So in that situation, you'd be down about $13, and that's just quick and dirty math. And if you want to see what it would be on a 30-day, if it came down and hit your strike, let's say there's only 30 days left to expiration, without using a pricing calculator, right? Boom. What's the at the money for a 30-day? Right here, December 20th, 28 days away, $6.85. So that would get your time premium back. So if you waited 60 days, so let's go through this pricing mechanism that I'm doing. This is the quick and dirty math using real markets, and that's what I prefer. So if you put this trade on, market stayed here forever, and then all of a sudden 60 days go by and the market goes boom, and it goes down to my strike, which was the 122 strike. Well, that means there'd be 30 days remaining, and that should be trading for where the 30-day at the money option contract is trading now. So that's always the way that I kind of manage my risk, and how I've always put together deep in the money call portfolios when I've talked about them and discussed them. But the good news is about options, and this is one thing that I absolutely love about deep in the money options, is as you go deeper and deeper into money, you get more shares, you get more delta, and it gives you more representation. So 122 would be our strike. This would be like with 30 days remaining. Notice that the delta is now 90. And if you get the stock to go up, it looks like you'd have to go up quite a bit. Now we're getting up to 97, 98 if it's right around the 100 strike. So as the market goes up and you get deeper in the money, you pick up more deltas. As the market goes down, and gets farther and farther away, what happened here? And gets farther and farther away from your stock, delta decreases and it hurts you less. So that's the way it is. All right. That's it. That's all I have for today's Options Guide TV. In addition to NVIDIA, if you'd like to get longer, but you don't have the ability to buy another 100 shares of it, this is a decent alternative. And if you really want to, you can go out further in time. The way I usually manage my deep in the money options is I put them on when the delta is 80. If the delta gets to 1, I will roll them up and roll them out. And if it comes all the way down and starts trading close to my strike price, i.e. the delta gets close to 50, well, then I'll just close the position and I will go and look for a different stock. Now you can manage it by doing price if you want, just the price of your option contract. But I always just kind of like to look at where the delta is and use that as a gauge if I should roll my option contract or close my option contract. All right, everyone, no more questions. Thank you for coming. Have a great weekend. On Monday, we'll try to come up with another SPX trade and see where we're at. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.